A balance sheet is a financial statement that reports a company's assets, liabilities, and equity at a specific point in time. It is used to summarize the financial position of a company, and provides a snapshot of a company's financial resources and obligations. The balance sheet is divided into two main sections, the assets section and the liabilities and equity section. The assets section lists the resources that a company owns and that it can use to generate income. These assets can be divided into two categories, current assets and non-current assets. Current assets are assets that are expected to be converted into cash or used up within 1 year. Examples of current assets include cash, accounts receivable, and inventory. Non-current assets are assets that are expected to provide economic benefits to a company for more than 1 year. Examples of non-current assets include property, plant, and equipment. The liabilities and equity section lists the claims against a company's assets. Liabilities are obligations that a company owes to others, and can be divided into two categories, current liabilities and non-current liabilities. Current liabilities are obligations that are expected to be settled within 1 year. Examples of current liabilities include accounts payable, taxes payable, and short-term debt. Non-current liabilities are obligations that are not expected to be settled within 1 year. Examples of non-current liabilities include long-term debt and pensions. Equity represents the residual interest in a company's assets after all liabilities have been paid. It represents the capital invested in a company by its owners, and can be divided into two categories, common equity and preferred equity. Common equity represents the ownership interest of common shareholders in a company, and is divided into two subcategories, common stock and retained earnings. Common stock represents the ownership interest of common shareholders, and retained earnings represents the portion of a company's profits that have been reinvested in the business rather than distributed to shareholders as dividends. Preferred equity represents the ownership interest of preferred shareholders, who have certain privileges over common shareholders, such as priority in the payment of dividends and liquidation proceeds. A balance sheet can help investors in several ways. First, it provides a summary of a company's financial position, which can be used to assess its solvency, or ability to meet its financial obligations. By comparing a company's assets to its liabilities, investors can get a sense of whether a company has enough resources to pay its debts as they come due. Second, a balance sheet can help investors understand a company's financial flexibility, or the extent to which it can respond to changes in its business environment. For example, if a company has a lot of short-term debt, it may be less flexible in responding to changes in market conditions because it may need to use its cash to pay off its debts. On the other hand, if a company has a lot of cash and little debt, it may have more flexibility to invest in growth opportunities or to pay dividends to shareholders. Third, a balance sheet can help investors understand a company's profitability, or its ability to generate profits. By comparing a company's assets to its liabilities and equity, investors can get a sense of how efficiently a company is using its resources to generate profits. For example, if a company has a lot of assets but is not generating much revenue, it may be less profitable than a company with fewer assets but higher revenues. Fourth, a balance sheet can help investors understand a company's risk profile, or the risks it is exposed to. For example, if a company has a lot of debt, it may be more risky for investors because it may be more vulnerable to changes in interest rates or economic conditions. On the other hand, if a company has little debt and a lot of cash, use code BLOG to receive 25% on your next purchase.